Welcome back to the Daily Crypto Roundup. Today is one of those days where the headlines are not just about Bitcoin moving up or down. Today is about the pipes underneath the entire crypto market being rebuilt in real time. We have a major US crypto regulation story, with the latest Clarity Act text opening the door for stablecoin rewards, while still protecting banks from direct yield competition. We have a massive retirement story, with President Trump's executive order pushing crypto access into 401k plans and potentially opening the door to a multi-trillion-dollar pool of long-term capital. We have Meta quietly testing USDC payments for creators through Solana and Polygon, which could be one of the clearest signs yet that stablecoins are moving from crypto trading into real-world internet payments. And we have a new Bitcoin quantum proposal that gives even Satoshi Nakamoto a theoretical way to prove control of old coins without actually moving them. So today's big theme is simple. Crypto is no longer sitting outside the system asking to be taken seriously. It is now being discussed inside retirement accounts, inside creator payments, inside US lawmaking, and even inside long-term Bitcoin security debates. Before we get into the stories, this episode is brought to you by Kraken. If you are looking for a trusted place to buy Bitcoin, Ethereum, Solana, XRP, or your favorite major crypto assets, check out the Kraken link in the description. Kraken is one of the biggest and most established names in crypto, and using our link helps support the show as we continue bringing you daily crypto news, market updates, and deep dives. As always, only invest what you can afford to lose. Do your own research, and never keep more on any exchange than you are comfortable with. And if you sign up with our link, we will give you 20 XRP straight into your new wallet. Just drop us a message once it's done. The first big story is the Clarity Act, because this could become one of the most important pieces of crypto market structure legislation in the United States. According to CoinDesk, the latest text would allow crypto firms to offer certain stablecoin rewards, but it would block products that look too much like traditional bank deposits. That distinction matters. Banks have been pushing hard against stablecoin yield because they see it as a direct threat to deposits. If people can hold dollars in stablecoins and earn rewards somewhere else, why would they keep money in a low-yield checking account? But the crypto industry has argued that rewards are not always the same as bank interest. Some rewards can be tied to actual activity, usage, promotions, or platform behavior, rather than simply paying users an interest rate for holding a balance. That appears to be where the compromise is forming. The bill seems to be trying to stop crypto companies from acting like banks without banking regulation, while still allowing legitimate reward programs that are not marketed as deposit accounts. This is a very important line. If regulators ban all stablecoin rewards, then companies like Coinbase, Circle Partners, exchanges, and fintech apps lose one of their strongest adoption tools. But if regulators allow everything, banks will argue that crypto firms are taking deposits without the same capital rules, insurance structures, and supervision. So, the Clarity Act is trying to thread the needle. It is not saying stablecoin incentives are dead. It is saying they have to be structured carefully. For the market, this is bullish in a measured way. It does not mean stablecoin rewards are fully protected forever. It does not mean every crypto yield product gets a green light. But it does suggest lawmakers are trying to create a workable framework rather than simply shutting the door. That matters for exchanges, stablecoin issuers, payment firms, and eventually tokenized finance. Stablecoins are not just another crypto sector now. They are becoming one of the main battlegrounds between Wall Street, Washington, banks, fintech companies, and crypto exchanges. And that leads directly into the second story, because Meta is now tapping USDC for creator payments through Solana and Polygon. According to Crypto.news, Meta has started allowing select creators to receive payouts in USDC through wallets on Solana and Polygon, with Stripe handling the payment processing. The rollout is currently limited, with reports pointing to select creators in Colombia and the Philippines. But the direction is very clear. This is not Meta launching another Libra or Diem-style coin. That old experiment collapsed under regulatory pressure. This time, Meta is not trying to create its own global currency. It is using existing stablecoin infrastructure, existing wallets, and third-party payment rails. That is a very different strategy. Instead of trying to fight the system, Meta is plugging into the system that crypto has already built. And this is exactly why stablecoins matter. For a creator in another country, getting paid in USDC can be faster, cheaper, and more flexible than waiting for bank rails, currency conversions, or local payment delays. Solana and Polygon both offer low-cost blockchain rails. Stripe gives Meta a regulated payment processing layer. USDC gives creators a dollar-denominated asset. Put those three together, and you can see why big platforms are testing this. Now, we should not overhype it. This is not Meta suddenly putting billions of users fully on-chain overnight. It is a limited rollout. It is targeted. It comes with warnings about wallet addresses, network compatibility, tax records, and user responsibility. If someone sends USDC to the wrong network, that money may not be recoverable. So this is still crypto infrastructure with crypto-style risks. But the bigger signal is extremely important. Stablecoins are becoming internet money. Not just trading money, not just DeFi money. Internet money. Creator payouts are a perfect use case because creators are global, platforms are global, and payments are still fragmented by country. If Meta expands this over time, it could push millions of people into their first real stablecoin experience without them ever thinking of it as crypto investing. They will just think of it as getting paid. That is a major shift for Solana and Polygon as well. Solana continues to fight for high-speed, low-cost consumer payments. Polygon continues to position itself as a scalable network for mainstream apps and brands. If stablecoin payouts become normal, the chains that carry those transactions could gain real utility beyond speculation. The third story is potentially even bigger long-term. President Trump has signed an executive order directing the Labor Department and other agencies to revisit rules around retirement accounts, with the aim of allowing crypto and alternative assets into 401k plans. According to Crypto.news, the order targets the roughly $12.5 trillion sitting in defined contribution retirement plans. Now that number is the key. $12.5 trillion. Not million, not billion. Trillion. Even a tiny allocation from that market into crypto would be huge. If just 1% of that kind of retirement capital eventually found its way into crypto-linked products, that would represent around $125 billion of potential demand. That does not mean it happens immediately. It does not mean every employer suddenly adds Bitcoin to their 401k menu tomorrow. But it shows why this story matters. Retirement money is different from short-term trading money. It is slower. It is stickier. It is usually allocated over years, sometimes decades. If crypto becomes a recognized part of retirement portfolios, even in small percentages, it changes the perception of the asset class. Bitcoin stops being viewed purely as a speculative trade and starts being treated as an alternative asset, similar to gold, private equity, commodities, or venture-style exposure. There are still big hurdles. Employers have fiduciary duties. Plan providers have to consider volatility, suitability, fees, investor education, and legal risk. The Labor Department still has to revise guidance. The SEC may have to assess access for retirement investors, so this is not an instant switch. But the political message is clear. The U.S. administration wants crypto to be part of the mainstream financial system, not locked out of it. This also links with Bitcoin ETFs. ETFs made it easier for institutions, advisors, and retail brokerage accounts to access Bitcoin. A 401k opening would go one level deeper into workplace retirement savings. That is where regular Americans invest automatically every pay cycle, often without actively trading. If Bitcoin or crypto index products eventually become available in that environment, the capital flow could become far more structural. And finally, we have one of the strangest and most fascinating Bitcoin stories of the day. A new quantum proposal that could give Satoshi Nakamoto a way to prove control of old Bitcoin without moving the coins. The proposal is called Provable Address Control Timestamps, or PACTs, and according to reports, it has been put forward by Paradigm. The idea is built around a future problem. If quantum computers eventually become powerful enough to threaten old cryptographic signatures, then early Bitcoin wallets could become vulnerable. Some of those old wallets include coins believed to belong to Satoshi Nakamoto. The nightmare scenario is that if quantum computing advances far enough, coins sitting in old addresses could be at risk. The obvious solution would be simple. Move the coins to a new quantum-resistant address. But for Satoshi, that would create absolute chaos. If Satoshi's coins moved, the entire crypto world would explode with speculation. Is Satoshi alive? Was it hacked? Was it a government? Was it an early developer? Markets would react instantly. So the question becomes, is there a way for the holder of old coins to prove control or protect ownership without actually moving the Bitcoin? That is where PAX comes in. The proposal would allow holders to create proof of control using cryptographic commitments while keeping sensitive details private. Later, if the Bitcoin network ever had to freeze vulnerable old addresses to protect against quantum theft, a holder could potentially use advanced proof systems to restore access without revealing everything publicly. Now, this is not something ordinary Bitcoin users need to panic about today. Quantum attacks are not suddenly emptying wallets this weekend. This is a forward-looking technical debate. But it is important because Bitcoin has to think in decades, not weeks. If Bitcoin is going to be a long-term store of value, then developers, investors, and institutions have to ask how it survives technological threats that may emerge far in the future. It also shows how seriously Bitcoin's developer and research community takes self-custody. The goal is not just to protect active users. It is also to think about dormant coins, lost coins, early coins, and the philosophical problem of whether the network should ever freeze coins to defend against a new type of attack. That is a very deep debate. Bitcoin is supposed to be neutral. But if quantum computers could steal from old addresses, doing nothing may also become a choice with consequences. So when you put all four stories together, today's Roundup has one clear message. Crypto is maturing on multiple fronts at once. Washington is trying to define stablecoin rewards. Meta is testing USDC as creator payment infrastructure. Trump is pushing crypto toward retirement accounts. And Bitcoin researchers are thinking about how to protect the network from future quantum threats. The price action today may look fairly calm, but the foundation is moving. Stablecoins are becoming payment rails. Bitcoin is becoming a retirement asset. Regulation is becoming more specific. And the technical side of crypto is preparing for risks that could be years away. That is why days like this matter. Not because one headline sends Bitcoin up 10% instantly, but because these are the stories that build the next cycle's infrastructure. The next major crypto bull run will not just be built on hype. It will be built on access, payments, regulation, retirement capital, and trust. Drop your thoughts in the comments. Do you think crypto in 401k plans is the biggest story here? Or is Meta using USDC the real signal that stablecoins are going mainstream? And if you are listening on Spotify, make sure you follow the show and leave a 5-star rating. It helps us massively as we keep growing crypto news today. Like and follow, and we will see you at the top.